flat this morning in Asia, around $113 on Brent. Sort of stuck in the doldrums, I'd say, a little bit. Malia Bengali, founder of MB Commodity Corner. As I say, Brent seems stuck in, again, this 110 to 120 bandwidth we've seen for some time now currently closer to the 110. But yet we have the IEA, Fatih Birol, the executive director of the IEA, screaming fire in the building, calling the fire brigades. Saudi Arabia needs to pump more oil. It's a major energy crisis. I think he called it a red alert. Is it a boy crying wolf, or is it that serious?
Thank you, Sean. Well, if you take a look at the oil market right now, we've just finished the first half of the year with equities and bonds having one of the worst performances in decades, going back to the 70s. Oil obviously had a very good quarter relative to oil, metals and mining, which were down 25%. So when you look at the oil market, the pure commodity players, they look at demand, supply, and look at inventories today. There is a shortage. We are at massive lows right now. And obviously at this continued rate of pumping, there's a concern that we may run out of oil. Having said that, what's happening on the macro side, and most commodity guys are unable to predict, especially the economists, is what's happening on the bigger picture. We're seeing massive demand destruction in like copper, aluminum, all these sort of asset classes right now. And oil, it just takes time to show up. If you take a look at the DOE data right now in energy, the 4-week moving average in oil is actually quite down. Gasoline should be at massive highs given this time of the year. Distillate is suffering as well, given the manufacturing slowdown. So our view is that this forward-looking demand indicator is what is reflected into oil prices, why it's not rallying. So you have a two-way pull. The macro guys are very bearish on oil given the demand destruction story in theory. And obviously we predict what happened to inventories going forward. There's a pure physical guys are looking at just the oil today. And we know that demand's not linear. Demand never grows at the same rate of change. And that is why we always have these economists versus traders and the two-way pull. At least that's our view.
Well, Omar Obeidly, sitting, of course, in Bahrain, Director of Research at the Bahrain Center for Strategic International Energy Studies. Joining the chorus with Mr. Fatih Birol is the great Boris Johnson, Mr. Churchill himself. That seems to be the man with no clothes on. I'm not quite sure. But Omar, Boris Johnson screaming for more oil. Please, please, please. Your thoughts on how desperate the supply side is, because I'm not seeing that in the oil price.
Well, when Boris Johnson speaks, that sound you can hear is scraping the bottom of the barrel, and he's looking down the back of the sofa for any policy that can generate some sort of a positive political force in his favor,
or distraction, perhaps.
Or distraction. I mean, this is Western rulers for 40 years have had a timeless strategy of blaming their economic woes on OPEC, and for many years OPEC has been a willing player in this charade. Because it makes it look, powerful and omnipotent and threatening to the West. On this occasion, Saudi Arabia is no longer playing this card. It's not interested in looking like the bogeyman or the villain. But by the same token, the Saudi oil policy is run by technocrats who don't have time for, short-term political cycles. So they just kind of ignore all this. But yes, Biden and Johnson and many other leaders have basically been making a fudge of their local macroeconomies, and as Malia mentioned, and secondly, they've completely screwed up their energy transitions, especially in case of European leaders. And if you can lay the blame for your poor planning and demagoguery at the feet of the Saudis, then by all means, why not?
Clyde Russell, Asia commodities and energy columnist at Thomson Reuters, sitting in the exotic Tasmania, wondering what is going on in Europe, I'm sure. But nonetheless, Clyde, I love the headline of your story, your column this week: Australia's commodity exports in the sweet spot of Russia's sanctions. It's great that somebody's in the sweet spot of Russian sanctions. Tell me, what's that mean?
Well, it basically means that Australia's earnings from its mineral and energy exports were at a record high in the fiscal year just ended this past June, of something like 405 billion Australian dollars. And the government forecaster is expecting them to reach $419 billion in this coming year. And that's mainly on the back of the fact that Australia is the world's largest exporter of LNG, which is of course going gangbusters, and it's also the world's largest exporter of coal by energy value. Indonesia exports more tons, but its coal is of lower quality. So if you look at those two things, the coal price has gone insane, especially thermal coal. The spot price is still close to $400 a ton. I know that's the price of last resort, and most people don't pay anything close to that, but they're still paying probably 3 to 4 times what they were in 2020 and 2019. So Australia is, notwithstanding the horrors of the war in Ukraine, Australia is actually, a country that is going gangbusters because of that. That's maybe a bit unfortunate, but it does mean that people predicting, recession in Australia are probably wide of the mark because there's just a huge amount of money flowing into the country.
That would be a reflection, I suppose, ultimately, maybe in alignment with Fatih Birol's sort of SOS call yesterday, that Australia is exhibit A of how red hot demand is.
Well, yes. I mean, it's just the sort of simple fact that they can't actually get enough supply out. I mean, anything that Australia can produce, be it or virtually any commodity, is being snapped up. And you've got to remember, Australia is also now the world's biggest producer of lithium, and that's another commodity in very strong demand. And so it's just going gangbusters. What the question always is, are the companies going to turn around and invest in boosting supply? And that's where I think things get a little bit trickier, because everyone sees this as a short-term play. Even the most optimistic of coal producers isn't thinking that coal demand is going to be growing into the 2030s. They're actually thinking the opposite. They're thinking it's going to be lower. So no one's going to invest in new mines. They'll run their existing assets as hard as they can. I think that also extends to the LNG. There are some LNG projects underway in Australia, but that's more to replace production that will be lost from aging fields. So it's, to my mind, what you're seeing is that story of an underinvestment in fossil fuels because people see this as a temporary sort of boost to prices. I think that's a sort of continuing dynamic.
Maliha, we saw in the early stage, of course, we're now, 4 or 5 months into the 5th month of this war, Russia's war in Ukraine. And clearly in the early weeks of the month, this was a massive bullish move on oil prices. It moved us sort of from the 80s to 90s into the 110s to 120s, where we've sat for a while. And now we're finally seeing, after many months, Russia's success on the battlefield. It seems every day now the next headline is Russia taking the next city, and most sort of worryingly yesterday the sort of signals that Russia's going to move on from here in terms of more territory. My question to you is, going forward, is Russia's successes on the battlefield bullish or bearish for oil prices and commodities?
Well, it all depends what the EU and the US do in terms of the sanctions. We know the sanctions have really not played a very important role in curtailing Russia's power, or at least their foothold in this war. The sanctions are very sort of late in terms of end of this year or next year. So Russia has a bit of a foothold here. Having said that, if the EU were to implement a ban, let's say today or now, then there would be a problem, because obviously there is maybe 1 to 3 million barrels per day of oil that could be in shortfall. Having said that, it's a bit confusing because Russia has done a great job. Look at India and China. They've taken up a lot of demand and a lot of the cheap barrels. And right now you have Iran even offering oil at a bit of a discount to meet Russian oil. So it all depends how much oil is stopped today. The problem is not 1 year from now, it's in the next 3 months. We're in a very critical period where supply is in shortfall. And if we are right on the demand destruction theory, that demand destruction is what's balancing oil markets. So if we get a very sort of big supply, sort of shortage, that 3-month window will look very tight. It is a day-by-day issue, but you are right. It depends what the EU does. But we've seen them not being very strong in putting sanctions because the EU economy is in dire straits right now. So they really don't have much of a leverage to do something.
Or maybe it depends more on what India does. Omar, I'd like to just take you to task a little bit on your sentiment regarding Joe Biden coming to the Middle East with a begging bowl for more oil. It strikes me that this visit is about much more than that. I wonder your thoughts on this sort of growing noise around a regional security pact that might see Saudi Arabia and Israel putting some signature on paper. Your thoughts on this sort of efforts to put together Israel's, UAE, Saudi, Egypt security pact?
Yeah, as I mentioned last time we were on, this energy and oil situation regarding or context is a red herring. Biden's not coming to ask for more oil. He knows it wouldn't make a difference anyway, even if Saudi Arabia did increase oil production. US inflation is is being driven by much more than rising prices at the pump. But in the context, you're absolutely right. The main reason for Biden's visit is he's trying to improve his domestic political strength or political popularity by basically squaring the circle of uniting Israelis and the Gulf monarchies in Egypt and Jordan in a front against Iran, ultimately as a precursor to, or as part of his efforts to reshape US's role in the Middle East. I'm not particularly confident he will be successful in that regard, but certainly that's the headline goal.
I mean, it's clear to me in that sort of analysis what the region gets out of it. Clearly, Israel, Saudi, UAE, looking across the Gulf, they now have a formidable potential security alliance that, blessed by Washington, that's a clear win for the region. But I don't quite get what Washington gets out of. What does Biden get out of it? I don't think that's a domestic win. People in Ohio don't give a crap.
Well, first of all, I'm not sure it's good for the region because having it, basically what would kick off is I'm sure it would generate an alliance that goes against it. And so what you might unleash is just a new type of arms race in the region. So it's not, ideally what you'd have in the long run, if everything went smoothly, would be something which involves everybody and everybody agrees on, rather than two big blocks balancing each other out in the region. But in terms of how...
I was just going to jump in there. Does it indicate that that bloc and the US with it have given up on the JCPOA and they're now accepting that Iran is going to go nuclear in terms of weapon capability? And so this is an anticipation of that, or is that an overreading?
Whether the JCPOA is ratified or not, or resurrected or not, is of no consequence, because the major threat these countries perceive in Iran is in the form of non-state actors, that in the form of the missiles, which will continue, in at large scale, whether the JCPOA is resurrected or not. But going back to your initial question about why would Biden be doing this? Well, because the reality is that the Israeli lobby in the US remains a very powerful source of political goodwill, and the US has made it very clear to anyone who's been watching closely that is not interested in being the policeman of the Middle East in any significant way for the foreseeable future. Maybe a few things here and there, like the Red Sea and the Gulf in terms of some shipping, but not the major sort of heavy-handed policeman we saw in 1991 when Kuwait was liberated. And as a consequence, the Israelis have come to accept this. And so now they want life's the art of second best. The second best is for them to be part of some big coalition which protects their security interests. And that's what Biden's offering them. Now, as I say, I'm not particularly optimistic it will come realized, but and
maybe it gives him political cover for a rapprochement with the Saudi leadership after having condemned it so vigorously in his election. If he gives the body politic of Washington a big prize of Israel's security, maybe that will be seen as worth it vis-a-vis rapprochement with Riyadh, given the dissenting voices in the Congress. Let's go to Clyde Russell again. Clyde, given the outlook that you just told us there, that you're all going to be getting paychecks from the government of Australia, your share of the 420 billion should be nice and chunky, one hopes, maybe at least a tax cut. But nonetheless, Clyde, is it a reflection or an indication of a very positive outlook for Chinese demand on all things, given that we're currently in a window of time in which Chinese demand looks a little uncertain?
I think we still sort of got to say Chinese demand does look uncertain. Certainly, if you look at metals as more of a leading indicator, iron ore and copper in particular, they're pointing, that China's not looking that healthy. I think what the problem with the market was, and this would extend to China's crude demand too, is that everybody was expecting a fairly strong, fairly rapid economic stimulus package from Beijing, and that just hasn't been forthcoming. While they do appear to have solved, for now at least, their COVID issues, we haven't really seen this massive ramp up in spending. Now, Beijing drums to its own beat, and it's very hard for even someone who spends most of their day looking at what's actually going on there to understand exactly what's happening. My guess is at some point they've made it quite clear they still want 5.5% annual growth. That is going to require some lots of stimulus measures. What they're trying to do is balance it between the sort of competing things. They don't really want to drive the iron ore price back to $150, $160 a ton. They don't want copper over $10,000 a ton. They don't want oil going up to 130, 140. So they've got to now balance their stimulus without it resulting in a massive, sort of increase in the major commodities that they import. So I think it's going to be a much slower burn this time round, because they actually really don't want to see massive amounts of higher prices. That's going to make it kind of interesting. I mean, if we look at it, their crude demand is down for the year, even though their economy is sort of recovering, and you're starting to see traffic congestion in Shanghai and Beijing again. We're not looking, the real-time data doesn't tell me that they're actually importing much more crude. And that's mainly because they've stopped exporting products virtually altogether. And that's why we still got all these high problems.
Given the sensitivity in Beijing and in China to these rising commodity prices, you would think that would warrant a phone call from Mr. Xi to his stooge in Moscow, but he seems to be more than happy to allow Mr. Putin to cause havoc in Europe and drive up these prices. I'm just wondering, is there a line there for Beijing, do you think?
Well, I think what the Chinese leadership will not want to see is a worldwide recession. So if they start to think that is actually something that's seriously on the cards, then that's very bad news for them. They're still fundamentally an export-focused economy. So if the Western world stops buying TVs, refrigerators, and all that kind of stuff, their economy goes down, and there's very little they can do about it. No matter how much bridges and train tunnels and stuff they build, it won't be enough. So that's where I think
Sarah Palin once said, the bridges to nowhere in Alaska, I think it was. But Maliha, speaking of recession, maybe that's going to be delivered by Mr. Powell, but it does seem that central bankers have kind of been pushed off the center stage. Their big inflation fight, is that still central headlines in Q3, big determining factor where the global economy goes?
Absolutely. So the central bank is monitoring the data on a month-to-month basis. I think we have seen past peak inflation numbers, especially the ones we saw back in May. We are seeing a lower rate of change print in the core PCE and the the CPI numbers, but we're still at very high numbers. I think the central bank will not be able to do anything vis-a-vis dovish rate cuts or provide more stimulus till the inflation comes down to more 2 or 3%. So for right now, the central bank is on autopilot. They're tightening. They're just sort of joboing the market, but they really are seeing these asset prices. They're a bit worried, but they don't have a choice. They have to keep this momentum until obviously the asset markets collapse further, something in the system snaps, or inflation comes down. So central bank's main focus for Q3 is to get the inflation down. And I think given the way the prices are moving, we are seeing the raw material prices come down. That should help alleviate the numbers. The only question is what happens in between? Is there talk about the housing market being in trouble? We've seen obviously prices in some cities, there's a lot of inventory. We've seen mortgage rates a lot higher. So the whole financial system is like a Jenga tower, as we always tell our clients, and little pieces are unraveling because we have so much debt in the system. How quickly those pieces come out is going to be a key determinant as to what happens to asset markets and how the Fed actually delicately balances that rate tightening cycle. And I think that's the key for Q3.
Omar, again, I wanted to get your thoughts before we go to the survey question as to whether you think Russia's successes on the battlefield will be bearish or bullish for oil prices going forward.
I agree with Maliha that it depends entirely on the nature of the European and Western response. If the response is to basically give up and say, okay, fine, Ukraine's gone, then I think it's going to be bearish for oil markets. If they decide to escalate, whether it's in the form of economic sanctions or potentially more aggressive military tactics, whether it's supplying Ukraine with weapons or something else that's more escalatory, then that's when we could have something, oil prices and energy prices in general going up. At the moment, I would say the most likely outcome, I'm afraid to say, well, at least I'm afraid to say in terms of the likely consequences for peace in the European Union, is that the European Union and its allies would basically back down if Russia continues to make military advances at the rate it's making. And in that sense, this will all peter out, and energy prices will start to go down. And the European Union and the West will be left looking very, very stupid, and will have lost even more credibility than they could have possibly imagined.
You wonder if that's a price they're willing to pay for peace and quiet in Berlin. I don't know. I wouldn't rule it out, as you say, Omar. Let's get the survey question in, which sort of tackles this question. Will Russia's continued success on the battlefield be bullish or bearish for oil prices? Maybe I should have added there in the Q3, but nonetheless, it's really a kind of second half of the year thing. Really, we're seeing for the first time, at least from a definition point of view, general acceptance, whatever propaganda has been moving in either direction, that Russia is having success on the ground in the eastern Ukraine. I don't think anybody's denying that now, and it is moving on from that position. My question is, will that be bullish or bearish for oil prices? Clyde, if we look at going forward vis-a-vis the crunch for the season ahead, demand in Asia, if we don't have solid demand in Asia or China, let's say the second half of the year, given all of the factors, zero COVID and other things like it, should that ease the pressure on Europe and the competition for LNG and other raw materials that Europe will need next winter?
I think it's more likely to ease the competition for crude more than anything else. I think you're still going to see quite a lot of competition for LNG and for coal, given that the fuels are used for different things. Coal and LNG are primarily for power generation and heating. Oil is for transport. So I think you might actually see that, there's still going to be incredible pressure on LNG demand, because I think the Chinese will still buy it. And the same goes for coal. Now, I've been doing a little bit of looking at this. Russia's actually increased coal exports in the last few months, unbelievably, because they've actually been selling a lot more to new people, and that's offset what they've lost in Europe and Japan. For instance, Turkey's purchases of Russian coal have exploded. But nonetheless, what I think you've got to separate out the oil market from the broader energy market, and I think that's where the trick is going to come. I would expect that if in some ways, your previous question about whether it's bullish or bearish if Russia actually performs better in the war is kind of irrelevant, because even if the West gives up, are they really actually going to go back to buying Russian oil products and Russian coal and that kind of stuff? No, that sort of self-sanctioning or formal sanctions will stay in place. So that doesn't solve the energy crisis; it just abandons the Ukrainians. So in some way, the West may as well stick it through, because the problem is not going away, no matter even if they give up. So it's an interesting dynamic.
Well, it strikes me that they've never really fought this battle, in the sense that they've never given the Ukrainians the weaponry, the real full capabilities of NATO. Obviously, they've given them a few things, but slow and drip feeding it. And it's already an indication that they're really not willing to fight this battle on the battlefield. And so you would think, as Russia gets the upper hand, that willingness or that lack of willingness will continue, and it seems to me that is ultimately bearish. Sorry, Clyde, you wanted to jump in on that?
Well, I was just going to say, everybody's in a race before winter. I mean, if you think about it, everything, Russia wants to win as much as it can before winter. Europeans want as much energy stored up before winter. OPEC Plus might actually start pumping more oil before winter. I know I'm in winter, but I'm talking for you Northern Hemisphere people. So it's all, everything's got to happen within the next 6 months. So for me, the what's going to happen is probably extreme volatility for the next 6 months, as everybody tries to get into that winning position. And the ultimate thing is probably no one will get into a winning position. That's how the world tends to work. Russia won't achieve all its goals. Europeans won't get enough energy stored up. OPEC won't pump enough oil. All these things are likely to happen, even if people make an attempt to do it.
What's interesting also, which I think is another factor to look into the second half, and maybe it's the cuckoo in the coal mine, but Iran cutting the price of its oil to compete with cheap Russian crude in China, where it had already cornered the market on discounted oil, and now Russia's stealing their lunch, and will increasingly we see greater competition at that discounted barrel in Asia. Malia, looking forward, this idea that we're stuck in this trading band 110 to 120, we've got some of our commentators sort of calling for that will break lower before it goes to the moon, so to speak, as we've seen some forecasters. Where are you at on the trend that would see oil break out of this rather tight band that it's been in for some time now?
We're more on the bearish side, as you've known, the way we've commented over the last few months. Our pictures are based on macroeconomic prop models, looking at demand indicators and current activity indicators. So combining that with our view on the micro situation, we think the momentum is more on the downside. The key here is refining margins. We know the tightness has come purely from products, as the refining utilization in the US is close to 94%. I think right now we are churning more products. It will take time, but together with the demand destruction, we think lower refining margins will see lower oil prices going forward in the next few weeks to months. Ordinarily, summer is usually a very strong time for oil prices, but right now we're going through a global economic recession. And there's no doubt that we are in a recession right now. Once it actually hits us, I mean, some indicators, most people talk about recession next year, but we know very well that asset markets price in recession way before it actually happened. So when it's actually happened, the Fed's already turned the other way. So our view is that this is actually a big slowdown, broadly speaking, and that should take oil prices lower.
Will that put a pause, the big question mark, on Fed outlook for a more robust tightening cycle?
Well, they'll have to see lower numbers. As much as the asset markets fall maybe another 10, 20%, we don't know. But the Fed is unable to do anything till that inflation number comes down to a much more meaningful 2 to 4% range, so to speak. Either that, or if we get like a housing crisis or systemic collapse in the credit markets, we don't know. They might reverse their policy. But the Fed's in a very precarious position. They know they can't do much, which is why they're trying so hard to raise rates as fast as possible, so they have some margin of error to cut if they need to. And that's really the dilemma they're in right now.
Let's go to Omar for final word with the survey result on the question. Bullish by 58 to 42. Somewhat of a tricky question, but worth starting to think about really as to where this is going. We saw obviously the sort of $20 to $30 push higher. We moved on the back of this Russia's war in Ukraine. Will that hold as Russia dominates or starts to dominate on the battlefield? That's a question we've asked today. We'll continue to ask it. But Omar, your closing thoughts on that question, and also the outlook for the OPEC Plus alliance, which is obviously expiring soon, and what the renewal looks like to you.
I'm just going to slightly disagree with Clyde when he said that Russia wants to get everything done before winter. I think on the contrary, Russia's quite happy to let this slide into winter, because during the winter is when European demand for energy will be at its highest, and it will be in a corner, and Russia will be, quite happy. And if you look at, Russian military history, then, they're quite happy to. Almost all of their victories are based on attrition, and just force of numbers. And they don't face the sort of political pressure domestically that you would see somewhere like the US or the UK when it comes to protracted conflict. So I think actually they're quite happy to soldier on through winter and squeeze the West as food crises and energy crises multiply. And I think all this, OPEC plus, demands, it's all just, as I say, it's just posturing and red herrings and attempts to score a few cheap political points. This crisis is OPEC Plus is absolutely nothing to do with the genesis of this crisis, nor does it really have anything to do with solving this crisis. Many factors were involved.
Does it have a purpose to continue just on pure market fundamentals, given that everybody's pumping or whatever they can, and this is really a group about restraining supply to elevate price rather than the other way around?
Well, so I think it's more metamorphosed from being about constraining supply, which is like the old OPEC, to more about stabilizing price by regulating supply. I don't think and I think OPEC members are pretty concerned about high oil prices, because, Maliha mentioned that there's demand destruction going on, and they don't want that either. I think what they want is some more stability, because what you've seen is the cratering investment in oil sector during the last 6-7 years, and that's not good for anyone. They want to be able to plan, and they would rather have, a consistent $80 price rather than these, cycles which just make efforts at fiscal balancing excruciatingly difficult.
Let me just give Clyde a chance to come back on that point that you've challenged him on. Clyde, I understood what you were saying was that the build up to winter, i.e. everybody's trying to fill their storage tanks right now, and that's the real crunch. Your thoughts, Clyde, on that point?
Well, I think everyone is trying to build enough storage. And I think the thing about Russia is I don't see it as as strong as perhaps Omar does. I think they're running through their troops and their equipment pretty quickly. Things don't work in winter as well. Yes, they've done well in winter conflicts when they've been the ones who've been invaded. Now they are the invaders. The shoe is on the other foot. It might be the Ukrainians who do well in winter. But I think, from my time in the army, I can tell you now, you can't keep people at the front line for very long. The effectiveness of a soldier dissipates after about 2 weeks. You've got to keep rotating. You've got to keep rotating. And I'm not sure the Russians have the manpower or the strength to do that. So I think they actually probably want to declare some kind of victory before they get ground down. I think winter is a bad outcome for them as well. Probably works more in Ukraine's favor. But maybe, yeah, it's.
Go ahead. Sorry, Clyde, close it out.
Yeah, I just sort of think that, as I said, it's a race now to see who can get as much of what they want in the shortest possible time.
Well, maybe all of those indications, the comments you're making sort of make me think that, well, maybe we're coming to a confluence where everybody's content to sort of raise a white flag by the end of the third quarter and say, well, I've won enough land. I've got my victories. We've defended enough. Perhaps, inshallah, maybe on some level for the Ukraine, most particularly, of course, they're at the front line of this horror. But for everybody else, some kind of a confluence of sort of consensus would certainly be, I said, much appreciated.
Maybe a job-seeking Boris Johnson could be a peace envoy at that point.
Yes, he could be the next Secretary General of the United Nations, I'm sure. We must wrap it up there. Omar, thank you so much as always. Maliha, great to have your thoughts. And of course, Clyde, thank you very, very much. We have oil prices trading, as I said, above $113 on Brent. They're kind of stuck in that little space. Let's see if that will continue or not in this week. Will this be the week that we break out? It seems unlikely, but we'll be here every morning, 10:30 UAE time, to take a sort of pulse of the market. Thank you, guys. Have a great day. All the best. Bye-bye.